Hello, Heart of Economy family. Welcome. Today we will dive into the perspective of one of the world's most followed economists, Mohamed El-Erian, to analyze the possibility of a Fed rate cut in July and the potential chain reactions this decision could trigger across the dollar, gold, silver, and equity markets. This video is not financial advice. Our goal is to help you interpret global markets through a clear, data-driven perspective, free from speculation and the strength for financial literacy. If you're ready, let's begin. Who is Mohamed El-Erian? Mohamed El-Erian is the Chief Economic Advisor at Allianz, former CEO of PIMCO, and one of the world's most respected macroeconomists. His insights frequently appear on Bloomberg, CNBC, and the Financial Times. El-Erian is known for analyzing Fed policies not cast through the lens of interest rates and inflation, but also by considering global capital flows, geopolitical dynamics, and the dollar's role as a reserve currency. He often emphasizes one key message. When reading data, we must look beyond the numbers to understand the soul of the economy. This is why El-Erian's analysis serves as a compass for investors and policymakers worldwide. According to El-Erian, the likelihood of a Fed rate cut in July is increasing. However, this is not solely because of headline inflation data. It is also driven by signals of a slowdown in the U.S. economy, the sustainability of the dollar's global role, and the need for balanced global capital flows. Slowing U.S. economy and the path of inflation. In the U.S., the unemployment rate has risen 4.1%. The CPI stands at 2.8% and core PCE at 2.4%. El-Erian states, the economy is slowing, inflation is easing, but maintaining high interest rates may unnecessarily increase the risk of recession. Why does he say this? Because high interest rates choke credit channels, slow down consumption and investment, and increase unemployment. Yet El-Erian draws a critical line here. Cutting rates before inflation is fully under control could set the stage for a much stronger wave of inflation later. This means that while inflation is trending downward, core data remains fragile, and a premature rate cut could jeopardize price stability. El-Erian points out that a high rate policy continues to attract capital to the U.S., keeps the dollar strong, but tightens liquidity and increases borrowing costs in emerging markets. He explains, if the Fed cuts rates, the dollar's appeal will decrease, capital flows may rebalance, but there is also a risk of a rapid decline in the dollar's value. The core message here is, global economic stability is not determined solely by U.S. domestic data, but also by the sustainability of the dollar's reserve currency role and the balance of capital flows worldwide. Our assessment, El-Erian's analysis clearly reveals the complex equation the Fed faces. Data is creating room for the Fed, but an aggressive rate cut without fully tamed core inflation could trigger a new wave of inflation. A controlled weakening of the dollar would benefit global balance, but a rapid decline could lead to global instability. This is why we believe the Fed is more likely to begin with a measured 25 basis point cut in July, and consider a second step in September. However, if a surprise 50 basis point cut occurs, all the chain reactions El-Erian points out will likely be triggered quickly. What does this mean? According to El-Erian, a rate cut decision in July would not be a simple domestic policy move. It would be a turning point that triggers chain reactions across the global financial system. A rate cut would eliminate the interest advantage that keeps the dollar strong. This could lead to a decline in the dollar's value, increase import costs, and reignite price pressures within the US. A weaker dollar and lower interest rates increase demand for gold and silver as safe havens. In silver, which operates in a low liquidity market, demand spikes can lead to rapid price surges. Initially, a rate cut can generate euphoria in the markets, but if this really is not supported by data, it may set the stage for sharp corrections. A rate cut lowers bond yields, reduces mortgage and commercial lending costs, and temporarily boosts economic activity. However, uncontrolled expansion could introduce inflation risks in the medium term. These potential chain reactions are a clear warning for investors. If the dollar weakens, there could be medium-term opportunities for gold and silver. Equity market rallies may offer short-term gains, but without data support, these rallies could pose risk for those seeking quick profits. The timing of the Fed's move will be crucial, as maintaining this balance is key to preventing inflation risks and preserving global stability in the long term. Today, we have examined Mohamed El-Erian's perspective on the potential for a Fed rate cut in July, its possible impact on the dollar, gold, silver, and the markets, and the global chain reactions it could trigger. El-Erian's message is clear. Pressure for a rate cut is increasing, but timing is critical. This decision will shape not only the US economy, but also the global financial system. This video is not financial advice. Our goal is to help you understand global financial developments with clarity and depth. If you would like more content with clear, current, and in-depth analysis, please like this video, subscribe to our channel, and turn on notifications. See you in the next analysis here on Heart of Economy. Thank you.